Did you recently get a letter from the Social Security Administration claiming that taxes on your Social Security benefits have been eliminated? If so, you're not alone, and you're probably confused. Thousands of seniors across the country are reaching out to SSA and media outlets for clarification because their benefit checks still show deductions. So what exactly is going on? In today's video, we're breaking it all down, from the misleading letter to what Congress actually passed and how this impacts your money. Plus, we'll explain how much seniors may actually be owed in unpaid benefits over the years due to low COLA adjustments. Welcome to Social Security Post, where we simplify government benefits and give you the facts that matter. Whether it's Social Security, Medicare, Medicaid, or retirement taxes, our mission is to help you understand what's changing and what you can do about it. So if you're new here, hit the like button, subscribe, and turn on notifications, and let us know in the comments. Did you receive this letter? And do you think Social Security should have been more clear about what it really meant? The Social Security Administration recently sent out a letter that has left many seniors confused and frustrated. This letter stated that taxes on Social Security benefits had been eliminated, a claim that would normally be cause for celebration. But it wasn't long before questions started pouring in. Why are taxes still being withheld from my checks? Why are news outlets saying the letter is misleading? The Washington Post even published a piece titled, "Social Security Letter on Taxes Sends Confusing Message." Clearly, there was a disconnect between what the letter promised and what was actually happening to seniors' money. The heart of the problem lies in how the message was worded. The letter failed to clarify that what had changed wasn't the complete elimination of taxes, but rather a new tax deduction that only applies to some seniors. By using vague and overly optimistic language, SSA created a situation where seniors expected more money in their pockets, only to feel disappointed and misled when they didn't get it. That's not just a mistake, it's a communication failure with real financial consequences for millions of Americans depending on these benefits. While the Social Security letter made it sound like taxes on benefits were gone, the truth is quite different. Congress did not eliminate taxes on Social Security benefits. It only introduced a new tax deduction for a specific group of seniors. A tax deduction simply reduces your taxable income. It does not completely remove taxes from your benefit checks. This is a major difference that caused confusion across the country. The Washington Post and other experts clarified that the language in the letter overstated the impact of this policy change. The actual legislation provides a temporary deduction for qualifying seniors, not a tax exemption. That means for many people, taxes will still be taken out of their checks, especially if they don't meet all the eligibility criteria. The centerpiece of the misunderstanding is the new $6,000 tax deduction. This benefit was introduced through the Big Beautiful Bill, but applies only to seniors aged 65 or older. If you're younger, even if you're receiving Social Security, you don't qualify for this deduction. Also, if your income exceeds $75,000, your eligibility for the full deduction begins to phase out. This means that many seniors who were expecting tax relief may not actually see any changes on their benefit checks. The letter failed to make this distinction clear. So, unless you meet both the age and income requirements, you likely won't benefit from this new tax deduction in full. Under the new law, seniors who qualify can stack multiple deductions to significantly reduce their taxable income. This includes the standard deduction of $15,750, the pre-existing $2,000 senior bonus deduction, and the new $6,000 deduction. When combined, this can amount to a $23,750 deduction for qualifying seniors. Stacking these deductions can help eliminate up to 80% of Social Security taxes, which is substantial, but it's important to remember that these benefits are temporary. They are only in place for 3 years, after which they will expire unless renewed by Congress. Seniors should use this window to plan wisely and adjust their tax strategies. Married couples filing jointly face additional challenges. If both spouses are 65 or older, they can combine their deductions to claim up to $46,700. However, if only one spouse meets the age requirement, the couple loses both the $1,600 senior bonus and the new $6,000 deduction, potentially missing out on significant savings. This disparity creates an unintended penalty for couples where one spouse is just a few years younger. Seniors should be aware of how their household's age and income levels affect their tax liability, and they may want to time certain financial decisions, like retirement claims, based on these deduction rules. The Big Beautiful Bill introduced valuable incentives for seniors who continue to work. If you're earning tips, you can deduct up to $25,000 from your taxable income. This is a game changer for seniors working part-time in service jobs, such as hospitality or caregiving, where tips are common and often taxed heavily. In addition, overtime pay is now deductible, up to $12,500 for single filers and $25,000 for married couples filing jointly. These deductions help make work more financially rewarding for older Americans. However, just like other provisions in the bill, these benefits will expire in 3 years unless extended. If you live in a state with high local taxes, like New York, California, or Illinois, the expanded SALT deduction is one of the most valuable changes. The limit has been raised from $10,000 to $40,000, which could significantly reduce your federal tax bill. This allows seniors to write off more of their property taxes, income taxes, and other local levies. However, this relief won't last forever. After 2030, the SALT deduction limit is set to drop back down to $10,000 unless new legislation is passed. Seniors in high-tax states should take advantage of the higher limit now and work with a tax advisor to optimize their filing strategy before the deadline. Charitable deductions also got an overhaul. There's now a clearer distinction between public and private charities when it comes to how much you can deduct. If you regularly give to nonprofits, especially those not widely recognized as public charities, you may find that your deductions are limited or subject to new rules. These changes also affect non-cash contributions, such as furniture, clothing, or vehicle donations. Seniors should maintain detailed records and get official receipts for every donation. Consulting a tax expert is more important than ever to ensure you're claiming your full charitable deductions without triggering an audit. The bill provides more support for grandparents and caregivers through increased education and dependent credits. The 529 education plan deduction has doubled to $20,000, and it now covers more than just tuition. It includes books, tutoring, and online courses. If you're helping a grandchild or child with school, these deductions can really add up. Also, the child tax credit has increased to $2,200 per child, and the $500 dependent credit is now permanent. This is great news for families with adult dependents or for seniors supporting grandchildren. These credits can significantly reduce your tax burden and help families provide a better future for their loved ones. Seniors who plan to buy a car should know about the new vehicle deduction. If the vehicle is assembled in the U.S., you can deduct up to $10,000 in loan interest. This is a big deal for seniors who need reliable transportation for doctor visits, caregiving duties, or everyday errands. But this deduction is temporary and only available for the next 3 years. It's also exclusive to American-assembled vehicles. If you're thinking about buying a car, now might be the right time to act, and make sure to double-check that the vehicle qualifies to get the full deduction. The cost of living adjustment, or COLA, for 2026 is projected to be only 2.7%. Many seniors are frustrated because this small increase doesn't reflect how much prices have risen, especially for essentials like rent, healthcare, and groceries. The problem is that COLA is based on the CPI-W, which only tracks inflation for July, August, and September. This narrow time frame often underestimates real-world expenses for seniors. That's why, even though inflation is high, COLA increases remain modest. Many advocates are calling for COLA to be based on the CPIE, which better reflects seniors' spending patterns. Until then, annual adjustments may continue to fall short. According to the Senior Citizens League, years of low COLA increases have left seniors far behind. They estimate that seniors would need a $370 monthly increase just to catch up with inflation over the past 15 years. That's not just a statistic, it's a powerful argument for urgent policy reform. This number could become a key figure in future congressional debates. Whether through a one-time adjustment or an overhaul of how COLA is calculated, the $370 gap shows just how far behind seniors have fallen. It's a reminder that Social Security isn't just about numbers. It's about dignity, fairness, and economic survival. We've walked through a complicated, confusing issue and hopefully made it clearer. The Social Security tax letter caused unnecessary panic because it suggested taxes were gone when in fact, they're still here for many. We also unpacked the deductions, working senior benefits, education credits, and COLA challenges that affect millions of Americans right now. If you found this helpful, please like this video, subscribe to Social Security Post, and comment below. Do you think the 2.7% COLA is enough? Should Congress provide a $370 boost? We want to hear your thoughts, and we'll be here every week to bring you the truth, break down every policy, and help you get every dollar you deserve.